Welcome, everyone, and thank you for joining us this evening. My name is Lauren Searle. I'm very excited to be hosting our third and final webinar of a three-part series designed to help you to get the most out of your professional corporation. Recordings of our first two sessions are available on my website, and tonight's recording, assuming that everything goes according to plan, will be available there as well in a couple of days. For those of you who may not be familiar with my practice, I've been running my own advisory practice for the last 26 years. We've always focused on applying a proven, repeatable process and tax smart planning to help our clients feel more confident and positive about their financial future. In addition to financial wellness, I'm a big advocate for physical wellness and senior wellness. Earlier this year, I hosted a webinar series focused on helping independent seniors to stay independent and thrive. The series was entitled From Old to Bold and included topics on fall prevention for seniors, fall fraud prevention, cybersecurity, and why estate planning should be a family affair. All recordings of the Old to Bold webinars are also available on my website. As I mentioned earlier, tonight is our third installment of our tax-focused series helping incorporated professionals. In the first two sessions, on September and October, we reviewed recent tax changes to the professional corporation, as well as why a personal wealth plan is critical to maximizing the advantages of your tax-deferred corporate dollars. Our guest presenters included our VP of Tax and Estate Planning Department and our Senior Tax Specialist. This evening's topic is tax smart investing inside your professional corporation. Our guest presenter tonight is Jason Middleton. Jason is another valuable member of our robust tax and estate planning team here at Richardson Wealth and is one of the foremost insurance advisors in Canada. Over the years, Jason has been a tremendous resource to my clients and my practice, sharing his knowledge, expertise, and wisdom. Before we get started on the presentation, I'll ask Jason to provide a little background on his education and experience. Jason, take it away.
Thanks, Lord. I appreciate you having me here tonight. I started my life out with Deloitte & Touche, doing audit when I graduated school. From there, I became a certified financial planner, and I've been we're focusing on insurance. I'm doing that for about 20 years. I feel like I'm dating myself, but I've been doing that just over 20 years. And I've been working with Richardson for just over 12. And enjoy it because one of the main benefits to working as a coordinated team is doing a plan and having everyone on the same page. And that's the most important thing, whether it's accountants, your lawyers, your other advisors, your investment professionals, your insurance people, they all have to be talking the same tune. Do you want to put that through the next slide, Lauren?
Yeah, sure. So, tonight's agenda, we'll be talking about the changes in taxation and what the issues are faced by incorporated professionals, investing inside the corporation, and managing passive income, which is becoming a very important aspect of managing your professional corporation. We're also going to touch upon what an individual pension plan is all about and who is it for, and why consider corporately owned life insurance. And we're going to start off here, Chase.
So thanks, Lauren. This is a bit of a roadmap, and I find with many clients, we're so busy doing our day-to-day work. We hear about the snippets. Unless you're in the business, you don't pay a lot of attention to it. But we hear snippets about what's going on and what tax changes have been impacted when the budget drops, so on and so forth. But I think history kind of gives us context as to where things might be going and the agenda behind those changes. So if we just look up from 2016, there's no secret that the government needs more money, but in 2016 they dropped the TFSA limit, which is a tax-free source of investment savings. In 2018 they expanded the rules on tax on split income. So that was splitting income was a way to defer taxation or spread taxation among family members. So they've gotten rid of that to force all the taxation into the hands of one individual. Then in 2019 they added the passive income tax rules, which we'll go through a bit later. And then this is a bit dated, but in 2021, they're talking about luxury tax and national vacancy tax. So, when you look at all of these things combined, it's pretty clear what they're trying to do. They're just trying to squeeze income into higher tax brackets and close tax sheltered investing, really. Just trying to recover, in my opinion, more tax revenue. Next slide, please, Lauren. So some of the tax issues that arise with investing your retained earnings. So this is money that you don't need for income. this is retained earnings in your corporation, is that a lot of professional corps or professionals don't realize that, they pay a low tax rate on that first active $500,000 of income, but on invested capital, there's a much higher tax rate, upwards of 50%. So a lot of people aren't aware of that. So investing in a corporation can be, there is a substantial amount of tax that is calculated. And then with the new passive income tax rules, there's the clawback to the small business deduction. So the more you save in your corporation, the higher your active tax rate is going to be. So they're going to claw back some of that small business credit that they give you at the front end. Next slide. So like I said, on passive income that's not deemed to be active, you pay upwards of 50% on certain types of income. A portion of that tax is permanent, a portion of it is refundable, because the Income Tax Act basis, it works on an integration theory, meaning we're trying to avoid double tax. So part of that tax will become refundable when a shareholder decides to pull money out of their corporation and trigger dividend tax. A portion of that tax, that permanent tax or Part 4 tax that you will have paid at that higher rate, will be refunded to the corporation. And that's called refundable dividend tax on hand.
And the CCPC, just to remind people?
Oh, Canadian Controlled Private Corporation. Right. Think of it, that's what people tend to think of as a small business. Right.
Next slide.
Yep. So the small business deduction limit, SBD, is the first 500,000 of income. And now it's among associated corporations. So if you have corporations with common shareholders, all of those corporations have to essentially now split that $500,000 limit. So what that $500,000 limit is essentially just the first 500,000 is taxed at as low as 12.2% here in Ontario. What ends up happening though is just like that small business $500,000 limit is shared amongst associated companies, this new AAII, or adjusted aggregate investment income, is also applied amongst all the associated companies. So it's kind of like a double whammy. And essentially what that means is that for every $5, your taxation, your small business deduction decreases by $1 for every $5 of associated AAII. So what that means is if you earn $150,000 of, let's just call it passive or investment income inside the corporation, you no longer have access to that small business deduction limit. So your effective tax rate goes from 12.2% on that first $500,000 of income, and essentially you'd be clawed back to be paying 26% on that income. So there's a differential there, and that differential, there's an increased cost of about $70,000. So, for very, very simple terms, if you want to go to the next slide, Lauren, if you had a $3 million portfolio in your corporation of passive investments earning 5%, let's call it, keep it really simple, of interest income, you'd be earning $150,000 of investment income, or income that's taxed at Part 4 tax rates, or what's called passive tax rates. Because that corporation earned $150,000 of passive income, that would no longer have access to the small business rate. So then it would owe an extra $70,000 in tax because you're deemed to be earning too much passive income. So again, this is really, in my opinion, targeted specifically, and hopefully no one gets offended at this. It's targeted at, in my opinion, professionals, doctors, lawyers, architects, real estate professionals, people that aren't running, I'm not going to call them true businesses, but they're not manufacturing business, and they don't have a lot of employees. They don't have inventory. They're not what you'd call a traditional business. And, it's pretty targeted. And in my mind, it's pretty simple to figure out. The government allowed all of these professionals to incorporate. So all these professionals that were earning big incomes and paying tax at 48%, got the ability to incorporate. And then they got the ability, instead of paying 50% tax, they went to paying 12% tax, and they got a big deferral. So now the government's looking at going, we haven't been getting our revenue. How do we stop this deferral? Right? Because they need the revenue. And that's really, in my mind, what this is all about. So this just graphically represents what I was talking about previously.
And that's $70,000 of lost income every year.
Yeah. So it's also very important it's a very important reason why all of your professionals need to be talking from the same page, right? The accountants, the investment professionals, the insurance people all need to talk and understand to try and manage that, to try and preserve that small business deduction. It's really unfortunate too. I was just thinking about this a while ago, is that just like low interest rates, 2, 3, 4 years ago, were causing people to make investment decisions, right? Maybe take more risk to try and find more yield. Taxation is getting so complicated and so punitive that it's forcing people to make investment decisions based on tax. And to be honest, I find that slightly disturbing. I'd rather make investment decisions based on a good investment and not have tax force my hand. But it's gotten to the point where it's so punitive that you can't help but have taxation impact how you invest.
Certainly needs to be considered, for sure.
Yeah. Next slide, Lauren.
Yeah.
So, and this is my opinion, I don't think we have a tax problem in this country. My dad always said, start with the problem, not the solution. I don't think we have a tax problem. I think the problem is debt. And if we want to get an idea as to maybe where taxation is going, I think debt's a good place to start. And I might be oversimplifying this. There's a lot smarter people in the world than me. But if we'd been sitting here 2 or 3 years ago, we would have been looking at going, we ran a $28 billion deficit. How did we possibly do that? And this next comment is not political, it's simply economic. We just burned through $600 billion. We went from $662 billion in federal debt to almost $1.2 trillion in federal debt. That's the expense side of the equation for the government. The revenue side of the equation is taxation. One of them is taxation. So I don't know if we're going to see a decreasing taxation environment anytime in the near future, given the amount of debt that we've piled on in the past 3 to 4 years. Next slide. This is more just to illustrate, give you perspective. So I think the perspective is important, just like understanding where debt is. These are just 3 different tax rates over time. And these years were actually kind of tricky to find. The red bar represents the top ordinary tax rate on earned income. And you can kind of see, other than 49 after the war, that top tax bracket has really kind of been above around 50%. So the details there aren't necessarily the absolute level of taxation, but more importantly, the level at which that's applied. That top tax rate used to be applied to at the 50% rate. Now it's applied at $220,000 of income. Unfortunately in Toronto, $220,000 of income, as crazy as it sounds, almost puts you in the middle income. But the big one here, my accountant always talked to me about tax is kind of like a teeter-totter. The lower corporate rates go, the higher personal rates go. So that green bar represents this active small business rate, that 12% I was talking about. So the difference between the green and the red bar, that's the deferral opportunity that you get by having a corporation. So essentially you get all that difference between the red and the green bar, you get that in your corporation to invest and grow. Then when you take it out, you pay that blue bar, and that's the equalization. That's the dividend tax rate that you pay on the way out the door. So the corporation, is not a tax avoidance or reduction strategy. It's simply a deferral vehicle. Next slide, please. And again, in my opinion, the 2 biggest, other than spending, 2 of the biggest eroders of wealth are inflation and tax. So if you look, and this is just to illustrate how punitive that taxation can be on building and transferring wealth. If you had $1 million, you started with $1 million and you were earning an 8% return year over year, and you had no tax and no inflation, that $1 million would be worth $10 million 30 years down the road. You start to add inflation to that $10 million drops to 5.5. You add the lowest tax rate that we have in Canada on deferred gains, that drops to just over $4 million. So as you pile on tax, that relative present value goes down to the point where you're paying tax on interest, which is the highest rate. That 1 million has really only grown to 1.7 million. So it's just an indicator of why it's critically important to consider taxation on your investments, and particularly where you hold those investments and the tax that's going to be applied. Go ahead, Lauren, next slide. Right, so there's a couple planning options you have, especially when it relates to the corporation, to sort of maximize that deferral opportunity. Own investments that generate deferred capital gains. Buy and hold, sell in years when there's lower business income. And this is why it becomes, again, important to work with your accountant to find out which years are going to be lower income and when you're triggering these gains. Consider the individual pension plans, if it's a good fit. And same thing, look at corporately owned life insurance as a separate fixed income asset class to grow your wealth and preserve and transfer that wealth when applicable. Lauren, I'll hand it back to you to maybe talk a little bit about IPPs.
Yeah, excellent. Thank you. So I wanted to talk about an interesting option that it's important that people are aware exists, because there's aren't too many ways to reduce your passive income, and IPP might work for you. So we're going to just talk about what an IPP is, who's it for, and how to get started if you're interested and think you might qualify. So this is all about an individual pension plan. So what an IPP is, it's like a registered defined benefit plan, except it's typically for one person. So think about teachers, think about QP when people know what they're going to get when they retire. It's a different animal than just having a lump sum and growing it. So when you have a defined pension, there's much more flexibility in how you're going to fund it, and it does allow for additional funding if the holdings aren't performing as expected, but more importantly, it just helps to make it differentiated from an RSP. So consider it as a defined benefit type pension. It certainly can create more contribution room than an RSP, and I'll talk about that in a second. And their first year past service lump sum contribution to IPP is very interesting, because it also offers some tax planning opportunities within the corporation. So again, the IPP doesn't generate passive income, and it helps you to manage it. And it's an alternative to the traditional model of growing your money tax deferred and taking those dollars out when you retire. It's no longer as easy given the passive tax clawback. With your regular contributions, an IPP can allow for a much larger annual contribution, up to 65% larger. So you could certainly supercharge your RSP from contributions, but I feel most importantly is the lump sum. So based on your past T4 income, and generally they're looking for significant T4 income in the last 10 to 20 years, you can really add a fair amount of lump sum, and we're talking about numbers between $500,000 and $1 million. And it really is important to look at what your situation might allow you to do from a lump sum perspective. It's other features to be aware of. It can offer creditor proofing, which a lot of people like, and it has some estate planning opportunities. Everything about the IPP is generated from the monies inside the corporation, and it's all tax deductible. So contributions, admin fees, advisory fees are all paid for the corporation. And when you retire, there's lots of options similar to the locked-in RSP. But with a locked-in RSP, as a lot of you will know, there are some limitations on liquidity. So if you're just looking for a consistent income on retirement, it works really well. But if you needed lump sum, just like you can't get it out easily from a locked-in RSP, you're not going to get it out easily from the IPP. Also, there's no spousal contributions like you could with a regular RSP. So just to sort of, before you pursue it, it sounds like a great idea, but not everyone fits the profile. So I thought tonight I'd give you an idea what the profile is, and it should certainly give you an idea whether you would qualify. So you have to own the business. If you're an incorporated professional, that works out fine. If it's just a regular business, you've got to be at least 10% owner of that business. And you need at least 10 years of T4 income. And that income can't be insignificant. It's got to be at least 150,000, and ideally more, close to 175, to get the maximum amount of previous contribution and future contribution room. Now, it suggests you should be 45 years or older, but it's pretty interesting how that lump sum contribution works. You could actually start this plan at age 71, where a maximum lump sum could be in excess of $1 million to get you started. So it is quite interesting, and don't be afraid if you're past 45 and looking into this. Also, you can't belong to another pension plan, so if you have one, you'll have to give that up. And it's also worth noting that you can't have an RSP when you are a IPP owner, and your RSP would get rolled into the IPP product. And that's a little bit about the profile. And I suggest, it's not one of those do-it-yourself projects where you can go to Questrade and say, hey, I want to open up an IPP. You really need to work with an actuarial firm, and we work with a company called GBL, which really takes the complexities and ensures that they manage those complexities and make sure your IPP stays compliant with government and pension regulations. And it's not that easy if you're doing it on your own. If even, I don't know if you even want to try it, but best to work with a specialist. And we start the discussion often whether you are a good fit by just doing a survey of how much income you've T4'd in the last 10 to 20 years, and to see if it's a good starting point for discussing it further. So I'll leave it at that. It's a fairly complex opportunity, but I will, like I said, happy to discuss one-on-one and see if it's a good option for your situation. So feel free to reach out if you want to learn more. I do have a brochure that I could email to you as well. So with that, I'm going to pass it back to Jason and go back to the agenda. So now we're going to chat about, Jason, I guess, why consider corporately owned life insurance?
So thanks, Lauren. And again, I'll go back to the plan. It comes down to what your individual goals and objectives are. Insurance can have a bad rap. And I think that's because it's something that's sold, not necessarily purchased. So in my experience, the best way to I'm product agnostic. The product doesn't matter. It really comes down to what's your goal, what are you trying to achieve, and does this make sense? So you kind of have to look at it in as unbiased a way as possible. And there's no silver bullet solution. Very often it's going to be a combination of several things to control tax and get you to your end goal. But that's what your professionals are for. That's why everyone needs to be working from the same page, so that we all have a cohesive discussion on what's in your best interest. So with that, Lauren, if you put it through to the next page, what we're talking about here is not term insurance, not risk-based planning. There's really two components to insurance. There's your insurance as a risk mitigation tool, which is your term insurance, your disability, your critical illness, your group benefits, your health and dental. That's stuff that you purchase or have for a certain period of time to mitigate a risk that's in existence for a certain period of time. Then once you reach retirement, those needs disappear. The need for replacing your income disappears because you're living off a fixed portfolio. The need for disability insurance to replace your active income disappears because you're no longer earning an active income. So you transition out of temporary products for temporary needs, and you look at, okay, well, what is permanent insurance for? And really, it's a way to accumulate capital and transfer capital on a tax-free basis. And it does that very well. The problem is when you try and put insurance into a box that it doesn't fit, that's when you get, bad experiences. So it's very important to make sure that we're using the proper tool for the proper goals and objectives. So, if we look at a corporation and we look at a traditional investment portfolio, as we did before, there's annual, this is not active income, this is passive income. So you've earned your income, you've paid your 12.2%. And you have retained earnings in your corporation that you're now investing. Well, there's an annual tax on that income, up to 50%, depending on the nature of the investment. And any deferred gains are taxed on death, right? If you access that investment, you pull it out of the corporation, it's taxed as well. You're sort of crystallizing that deferral or triggering the tax, and you're losing the deferral opportunity. Then on death, all those investments are liquidated. All deferred gains are taxed, and then the dividends that come out to the next generation are taxed as well. So there's that by the time death rolls around, unfortunately, that entire deferral is lost. and potentially, and then some. So when you look at insurance, what can that do to help smooth? What's the goal? What's the objective it's solving? Well, first, this again is a permanent policy. We're not talking term. So we're massively over-investing in these policies, which is causing a large buildup of accumulated investment capital, which is also now growing on a tax-deferred basis. So any growth that happens, kind of similar to an RSP, any growth that happens inside of an RSP is tax-deferred. Any growth on invested capital inside of an insurance policy or cash value is tax exempt. So you're not paying that passive Part 4 rate. You're not subject to, it's not being included in the AAII, which is causing a clawback in the small business deduction. So it's helping control the level of that investment income, okay? And it's tax-free on death, right? It is accessible, so that cash value in the insurance policy is accessible via loan, direct withdrawal, or collateral loan. So each of those would have a different tax consequence. If anyone wants to talk about those later, we can. But most importantly, on death, all of that capital is paid tax-free into the corporation. And then it can actually flow out of the corporation on a tax-free basis. And this is huge. So again, it goes back, and I've done this planning for myself. It goes back to what's the ultimate goal? So this would be long-term investment capital. It'd be a way to accumulate tax-deferred inside the corporation. So you'd avoid that Part 4 rate. And it would be really a substitute for fixed income. So when we looked at that graph that showed the impact of accumulation of wealth, the impacts of inflation and taxation, the most punitive was inflation and interest income. So if you look at the insurance policy as an alternative to traditional fixed income, because they're the least tax efficient, that's really where it fits in. So it becomes just a component or a subcomponent of your fixed income portfolio, right? Or maybe the best way to sort of review this is with an example. So if you want to go to the next slide.
I was just going to say, from my experience, when we talk about, when I've talked to clients about insurance, the idea of having access to a cash value when you're involved in insurance is new to a lot of individuals. Most people associate insurance with a sunk cost that never is retrieved, and it's really quite compelling how flexible and how accessible at the same time the insurance asset can be within your portfolio. So let me just go forward here.
So here's an actual case study. Obviously, names have been changed, but so we had, Eric and Dana. Eric was an entrepreneur. Dana was a real estate agent, 2 kids, and they're looking at potential retirement in 10 years. So the household income is $700,000 annually, 200 and 500 respectively, with a $5.5 million net worth. So the 2 of them are feeling that, especially Dana is feeling that top 54% personal rate. They have a $3 million portfolio in the holdco, so they are also experiencing that that full clawback of the small business deduction. So the corporation is now paying a much higher tax rate than it was previously. They have $1 million in registered savings plus 1.5 million in equity in the house. That holdco has anticipated retained earnings of an additional $250,000 per year in recurring revenue for the next 10 years, which is their potential partial retirement timeline. So some of the pain points that they were feeling were they're both tax sensitive and they're maxing out their registered plans. So they're taking full advantage of their TFSAs with their personal income, and they're taking full advantage of their RSPs. They are subject to the passive income tax rules. And like I said before, they're losing that small business tax rate. So they're paying that extra $70,000, or they're going to have to start paying that extra $70,000 tax corporately. And then more importantly, in speaking with them, they had 2 conflicting goals. Eric wanted to make sure some of the kids were taken care of at the end, so long as it doesn't impact their retirement. And Dana was more concerned with just spending money and enjoying retirement, less concerned about more wanting to help the kids while they're alive, as opposed to leaving them a bequest at the end. So part of our goal was say, well, you have these different goals. How do we best accomplish them? And if those are your objectives, then we have to start getting tactical and saying, how are we actually going to achieve them? How are we going to, minimize tax, but how are we going to leave the assets to the kids? Which assets are we going to pick? If I kept it very, very basic, if you wanted to leave each of the kids $1 million at the end of the day, and you wanted to do it with a registered plan, Dana and Eric would have to not spend $4 million in registered money in order to leave $2 million net after tax in personal money to the kids, because that RSP is fully taxable through the estate. Similarly in a corporation, they'd have to not spend, call it $3.5 million to leave $2 million net to the kids. So the cost to their, retirement is $4 million or $3.5 million, because at the end of the day, money is finite. So, my perspective on it is retirement is about all these different objectives, and how do I achieve each of the objectives in the most efficient way possible? So if, accumulating capital in the corporation, reducing tax is great, and leaving money to the kids is important as well. The less amount of money I have to take out of, the retirement assets to achieve that bequesting goal, that inheritance objective, the more money by default we leave in the portfolio for all the other things that they want to do. So it just becomes, it's not about necessarily leaving the kids more, it's about achieving that objective with the least amount of capital committed as possible. The important to them was accessing long-term cash values. So, they had enough wealth that they're not worried the next 20, 30, 40 years what's going to happen to them, but longevity is a concern. So what happens if, one of them reaches 90, 95, 100, and they've spent all their money? They don't want to necessarily leave money to the kids and be, in poverty. So having a large tax deferred pool of capital that they can access was also very important. And then looking at alternative tax savings vehicles, especially in the corporation. So where we ended up is we decided to allocate $50,000 per year to a permanent insurance policy. So this is the joint and last die policy. So it's a policy that pays out when the second of Dana and Eric pass away. And the reason it was structured that way was because the less risk we give an insurance company, the less we're going to pay. The risk of two people dying is significantly less than the risk of one person dying, so we're driving down the cost. So the point is, drive the cost down as possible, drive the deposit as high as possible. Therefore, you're accumulating as much equity in the policy as possible and maximizing that deferral opportunity in the corporation. So where we landed was $50,000 per year for a period of 10 years, which also coincides with their corporate cash flow, which also coincides with their planned retirement. And $50,000 a year into an insurance policy, if you think about it like an expense, it seems like a big number. But what we're allocating is 1.25% of their liquid net worth. So we're really saying we're going to reallocate a very small portion of the growth on your portfolio, with the primary purpose being intergenerational wealth transfer on a tax-free basis, the secondary purpose being tax-free accumulation of capital within the corporation. Okay, so do you want to go to the next slide?
Yep.
I kept this really simple, 2 lines, paint by numbers. This is the cash value in the permanent insurance policy, so the sum total of 10 payments of $50,000 compared to a traditional portfolio of interest and dividends. The reason I compared it to interest and dividends is because, again, the insurance is a replacement for a portion of the fixed income component inside the corporation, because fixed income inside of a corporation is taxed unfavorably. So let's take the least tax efficient investment vehicle inside the corporation, and let's put that into a tax shelter, which is the insurance. So the green line is the actual equity cash value in the life insurance policy over time, and the purple or blue line represents what a traditional portfolio would be worth, earning 5.5% pre-tax, pre-fee return. So you see in the first 10 years, the traditional portfolio outstrips the cash value, the equity in the life insurance policy by a small margin. And the reason being is because there's a cost of insurance that's sort of putting a bit of drag on that insurance policy. But over time, and if we're really looking at this as a long-term asset, that tax-free compounding really starts to have an impact 12, 15, 20, 30, 40 years down the road. So for Dana and Eric, this is a small component of their corporate portfolio. So if they need it, it's something that they're going to access, 20, 30, 40 years down the road. It's not something they're going to access 5 or 10 years. They have lots of other assets that they're going to touch for that. So we wanted to find a way to maximize that long-term value of that $500,000 contribution over 10 years. So there's a huge margin of advantage over the long term. right? If you want to scroll to the next page. But the big advantage here is that we're looking at this as also if that cash value is not required. So if we've done our planning properly, Dana and Eric are never going to need this money because we've just allocated a very, very small component of their overall net worth. So it's great as a secondary, I kind of call it a long-term retirement emergency fund, and it's there if we need it. It's there for investment purposes if they need it, and they can access it in a bunch of different ways. But if they don't need it, then it was going to the kids anyway. So let's sort of crystallize that that deferral and make it permanent. And we do that by changing the nature of it from a traditional non-registered investment into insurance. So on death, that cash value plus the insurance pays out as a tax-free death benefit into the corporation, because this would be owned by the corporation with the corporation as the payor and the corporation as the beneficiary. Then on death, that death benefit pays into the corporation and tax-free, and then the corporation or the future shareholders of that corporation can elect to take that death benefit tax-free up to the capital dividend account credit, that capital dividend account amount. By your mid 80s to early 90s, that capital dividend account will equal the death benefit. And all that means is that that full death benefit would come out of the corporation on a completely tax-free basis. So we essentially turned $500,000 of pre-tax personal money into, $2.5, $3 million of net after-tax personal money. There's a huge lift on that. So I really just essentially done more with less, or looked at another way. I've used less of my retirement capital to achieve that inheritance objective while still giving myself or my clients access to, that tax sheltered accumulated value if required for retirement. I'm not sure, Lauren, did you want to open up questions, or do you want to take questions offline? What are you thinking?
I'm thinking in respect to the people who started on time and we just committed to 45 minutes, obviously there's a lot of complexities behind the opportunities that we talked about today. And I actually feel that it's better to discuss individuals' unique situations to see if these are appropriate strategies for them. So I think in little questions, I'm going to ask everybody if they could to reach out to myself by email, and then I'll involve Jason and we can get back to you with answers. We're running a little bit late today, so I apologize for that. But again, I want to thank everybody for attending, and I hope you found the presentation informative. There certainly are some very interesting tools to help work with the passive income grind a little bit more efficiently. And it all, I believe, boils down to getting back to a personal wealth plan and integrating your professional corporation along with what your goals are and what your personal financial situation looks like. So I think I'm just going to wrap it up here and thank everybody for attending. Jason, thank you so much for your time this evening.
My pleasure.
Please send us an email and reach out if you know anybody who might have missed this or would benefit from listening to the recording. It should be available in the next couple of days on our website. So thank you very much, and I hope everybody has a good evening. Take care.